A very good evening to all. I warmly welcome all the participants, esteemed members, and our eloquent speakers here, Amitav Basuji, to this virtual CPE meet organized by Committee on Management Accounting of ICI and hosted by Gurugram branch of NIRC of ICI on the topic Management Accounting Insights, Value Capture Finance, Top Management Perspective. Now I will request Ye Nitin Kataria ji, Chairman, Gurugram branch of NIRC of ICI, to officially introduce today's eloquent speakers, Ye Amitav Basu ji, and welcome all the participants to this virtual CBE meet. Over to you, Nitin ji.
Thank you, Ritesh ji. Thanks a lot, and a very good evening. A very good evening to our senior and respected speaker of the day, Amitva Basu ji. Very good evening, sir. And my colleague from Gurgaon branch and Vice Chairman Mohit Singhal has also joined. A very good evening, and a very warm welcome to all the respected members of the Institute of Chartered Accountants of India. Firstly, I would like to thank the Committee on Management Accounting for giving us an opportunity to host this wonderful program, and not forgetting to mention that value capturing finance. So this is such an unique and interesting topic, which on which we'll see a host of deliberation from Basuji, and he is one of the senior member of the institute and having ample experience in this field. And I will not be able to explain this topic in a very good manner, because we are having Basuji, who is having an expertise in this field, and he'll do the proper justice. Just to give few intro of the topic, this value capture financing from the top management perspective. I think this value capture financing is one of the very important way of raising finance and to develop, and it is more of a related to the infrastructure, like roads, like ports, metros, highways, renewable sectors, and the power projects. And for this, the Indian government has also set up an IIFL, India Infrastructure Finance Limited, and subsidiary of also a subsidiary in India IIFL Projects Limited. So they are taking care of this sector, and they are coordinating with the ULBs and the local municipalities. And they are also related. It is also related to financing. They are providing the infra finance, the senior debts, and more way of funding. The best thing in this is, suppose we are into the center, like we take an example of Gurgaon city. We are sitting into the heart of the city, but what about the outskirts of the city? So for that only they plan in such a way that they introduce a periphery to the city, so it goes like in a diameter. So for with this, they are able to increase the value of the land there. They are able to get enhance it. They are able to encash the increased value by raising the proper taxes, and by monetizing the land, by giving the opportunities to the people. So it is this kind of improvement in the land also, land and revenue collection also, by coordinating with the local municipalities and all that. So in this way, the bid rent graph is also taken care of, because in the center the rent is high, and as you go into the outskirts, there would be low value, and so the bid rent value is also increased in this. So I'll not take much of time, because we are having Basuji, who will give a very good insight on this topic. And once again, I'd like to thank the Committee on Management Accounting to give us a chance to host this wonderful program. So thank you, Ritesh. Over to you. Thanks a lot.
Thank you so very much, Nitin ji, for such a warm welcome and your insight to this topic. Now, our eloquent speaker for the day, Sri Amitav Basu ji, is a distinguished personality, and let me run you all through his profile very briefly. Amitav Basu is a fellow member of Institute of Chartered Accountants of India. He holds a master's degree in commerce from the University of Kolkata and bachelor's degree in law from the same university. He has worked as a president, Intercontinental Consultants and Technocrats Private Limited. Amitav has over 4 decades of experience covering financial management, institutional development, capacity development, and triple P structuring. He has worked in India and abroad, which includes developing and transition economies as well as conflict countries. Amitav was a faculty at Xavier Labor Relations Institute, Jamshedpur, in Finance and Control Stream for the PGDM course. Amitav is a member of various professional associations and currently co-chair working group on subnational government of the International Association of Schools and Institutes of Administration headquartered at Brussels, Belgium. He has also served as a member of various task forces and committees of different state governments. Amitav has authored two different books, Sustainability Reporting and Due Diligence, published by the Institute of Chartered Accountants of India. His articles have also been published in several national and international professional and academic journals. As we all know, again, Amitav ji is a distinguished personality. Now we all are very eager to hear it from the man himself. Over to you, Basuji. All yours for the moment. Basuji. Can you hear Basuji?
Yes, I can hear you. Okay, thank you for the kind introduction and a very, very warm and good evening to all of you. So I'll just start sharing the screen with my presentation. Please let me know if you could see the presentation screen. Is the screen visible,
Yes, sir.
Ritesh ji?
Yes, visible.
Okay.
Visible, sir.
Okay.
Visible, sir, visible.
Okay. So thank you once again. I start today's presentation and the discussion, which, as told by Kataria Sab, it is on the management accounting insights for value capture finance from top management perspective. Now, this term value capture finance is perhaps a term which is quite new to us, and therefore I will just first lay down that for the purpose of today's discussion on this value capture finance, what would be the items that we will cover in this presentation. First is the change in land value. Please hold on for a while I proceed with the agenda of today's presentation, and I will explain that as we go on. So the first item is the change in land value. Second is the concept of value capture finance. What is value capture finance? Already Mr. Kataria has given a very good brief on what this value capture finance is about, but we will elaborate on that during the course of the presentation. The tools or the means by which the value could be captured for finance raising, and what are the value capture options or means available. Then its application for public bodies, that is the municipal corporations, urban local bodies and similar institutions for which the value capture finance is truly and appropriately applicable. Then the question of land monetization, the term has been introduced and mentioned by Mr. Kataria in his welcome address, monetization. And then we come that whether and how this value capture finance or land monetization is relevant for the corporate sector, which is not just the public bodies or the municipal corporations, the challenges ahead, and what could be the way forward. So briefly, that is the agenda for today's discussion. Friends, during my childhood days, I remember even now at a very advanced age of my life that during the childhood days, I have heard of a English song in a Western movie, Sound of Music. And it said, nothing comes from nothing. Nothing ever could. And I believe, even at this age, in the philosophy implied in that song, nothing comes from nothing, nothing ever could. So believing in that philosophy, I will take some time and kindly bear with me in understanding that before we come to what is value capture finance, a brief background which we can term as foundation for today's discussion. Because there are two questions and pertinent ones that can arise when we hear the term value capture finance. The first, value capture of what? Yes, it is capturing the finance value, but of what? Of what item? And the second is that what are we trying to capture, that is to get, to obtain, or to seek from that item. The item on which we are discussing, that is the value of which we are considering to capture as a resource, that is as a source of fund, is land. Usually, if we look at any balance sheet, friends, you will agree with me, land is considered as an item of application of fund, and it therefore appears on the asset side of the balance sheet as an application of fund. Do you agree with me? And it is shown at a historical cost, that is the cost of acquisition and development. But land, with the various development that goes around its surroundings, its vicinity, also changes in terms of its value. That is, the value, the cost at which that land was acquired, or the cost at which that land was existing earlier, changes as the roads come up, accessibility becomes easy, as electricity comes up, power becomes available, water and sanitation is available, telecommunication is available, that is other various infrastructural means are available. So the usability of land, the accessibility of land becomes much more beneficial and much more useful to the landowner. And its value changes. And once the value changes, it can become a source of fund. How? Here I will make one digression. Forget the concept of value capture finance. Forget it for the time being. Though we have not come to the concept, at least the term value capture finance. You may recall, I could very well remember, because I'm today quite an aged and an elderly person, that when we had the MRTP Act, Monopolies and Restrictive Trade Practices Act, and then there were a lot of constraints for many large companies. So to raise funds through borrowings, especially through the bank route, this land used to be revalued, because as I mentioned in the beginning, land is represented or reflected at historical cost. But its value changes, and therefore the land revalued and the value increases. And when that value increased, that land was given as a security, as a collateral to the bank to raise fund. So it became, at that point of time, a means to raise fund. Maybe a debt fund, but a means to raise fund. So the concept that land is not just an investment, is not just an application, but it could be a means or a source of fund is what this value capture finance deals about or speaks about. And it is applicable equally to the public bodies and institutions like municipal bodies, municipal corporations, urban development authorities, and in today's context, the smart city companies, as well as for the corporate sector to use as a source of fund for getting financial resources. So that is the part which I wanted to explain, that it is land. Land is the item whose value we are talking of capturing. Now let us see that how, I have said the value of land increases, but how does it increase? And from this chart or this graph, you will find that the blue line, which shows also an increase, is an increase in value without public investments around the land. Because land, you will agree with me, friends, is an item on which we do not generally have depreciation. It does not depreciate. And it does not depreciate, you will agree, because with land being a definitive in terms of quantum, it is not, indefinite, and there being increase in population, increase in demand for use of land, the value of land as per the basic economic concept of supply and demand increases. And that increase is in value, in terms of the value of land, is reflected by this blue line, where you do not have any investment, any development around the land, but the value increases on account of supply being restricted, demand having outstripped or grown up. On the other hand, when we go to the other line, which is the light green line, you will see there is a steep increase. And that increase happens when there is public investment, when the infrastructure is developed, and as a result of which the accessibility to the land, the usability of the land increases manifold, and as it increases, demand increase and value increase much more higher than the value of land that increases without there being any development in and around. A glaring example of that is Gurgaon. Just consider, from today, some 40 years back, 35 years back, what was the price of land in Gurgaon? And it had increased, no doubt, but not at that phenomenal rate at which it is increasing now for the last 20-25 years on account of the infrastructural development in terms of road connectivity, in terms of other infrastructural development like bridges, like telecommunication, power, water, etc. And therefore, with investment from the public sector, mainly the town planning on institutions, the urban local bodies, the government, and maybe also some from the private sector, when there is infrastructure development around the land, the value increases manifold. So that is how the land value changes. Having said that, as I said, it applies to both public bodies and institutions, and we will first see how it applies to public bodies and institutions and how historically the concept of value capture finance has emerged for using the land value with its increase in valuation for raising funds for development. Let us look into that. As I mentioned, that development of infrastructure or facilities result in positive externalities that drives up the value of land, whether it is held by the public sector or by the private owners, that is, the privately held by communities. When there is a road, that road could be used by all and sundry. When there is telecommunication lineup, it can be used by all and sundry. When there is water and sanitation, it can be used by all and sundry. And I will again make a digression here. The digression is that when we talk of human settlement or human habitat, which includes residential as well as commercial and both, the definition of human habitat as per the habitat agenda, which was declared long back in Istanbul under the UN Convention, says that a human habitat is a place which is livable. And it is livable not only when you have brick and mortar houses. It is livable not only when you have only a road. It is livable when you have safe, sufficient quantity of water, you have hygienic sanitation, you have commercial places like markets, like malls, to buy as well as to sell. You have educational and health facilities which you can use for your children, for yourself, for your family. You have recreational facilities, and all that together makes it a human habitation or a livable place. So, when that road, that electricity, that power, that park and playground, that market and malls come up, the value of the land increases and it makes it more livable, more usable, and so the value goes up. Realizing and recognizing this aspect, in 1976, in Vancouver, in Canada, the United Nations Habitat had a discussion and a Vancouver human habitat action plan. Amongst many other things, it was proclaimed that the unearned increment, I'm just reading out, which is in red color, in bold in the slide, the unearned increment resulting from changes in land use, from the rise in land values emanating from public investments or decisions, or due to the general growth of the country, must be subject to appropriate recapture by public bodies. In other words, when the infrastructure is developed, when there is development around a piece of land or certain parts of land, and that land is not sold, but the value has increased, that value is an unearned or an unrealized gain in the of the infrastructure developed through public investments, because there is more people coming in, growth of the community there. Gurgaon is an example. And because the usability of land is in different forms, so the value increases, the is unrealized. And the Vancouver Action Plan says that unrealized increment in the value of land due to the development should be captured appropriately by public bodies, is the municipal corporations, the city development authorities and the likes, because that would be a source of fund for these institutions to further develop that part of the region or in the vicinity or elsewhere. And so the concept of value finance, which we will call it as VCF during the next course or during the course of our presentation, it has emerged from the 1976 Vancouver Action Plan. So it is a concept which has come up from there, and which basically is based on the principle that the private land and buildings benefit from the public investment in infrastructure and policy decisions of the government. As I said earlier, that when you build a road, when you build a market, when you build a recreation facility, it benefits all and sundry. It does not create a wall or demarcates that this is only for the public sector and not for the private sector. And therefore, even if there are any private ownership of land and buildings in that particular region, that particular place where such development has happened, there the value of the land or even of the private property increases, enhances. And from here we have two things to understand. The understanding is, one, that it increases the value of land as well as the structures and buildings there across for all. And where you have the private ownership, that is where, if it is a corporate ownership, it helps the corporate also to capture the finance, the value capture finance from this land value enhancement. And I will come back to this point towards the end of the lecture. I can explain that how this concept can be extended also to the corporate sector. Now, to further explain and clarify the concept of value capture finance or VCF, it is a virtuous cycle. It is not a vicious cycle. It is a virtuous cycle. A virtuous cycle where you have an item, you have an asset, that is the land in this particular case, and you add value to it, you create more value to that land by the development of the surroundings, and you then realize the extra value through different means, which is not necessarily that you sell off and get the money, you can have the asset, and which we will see later, and still realize the funds, and which fund you can recycle or you can reuse for further investment. That is the virtuous cycle which I am referring to. Now, why I am harping on this point again and again, and please pardon me, forgive me for being repetitive, is to have our understanding absolutely clear and transparent that we are actually, through the infrastructural development, adding value to that piece of land which was there. I remember a long time back in a village which now has been in the Giridih district of Jharkhand. We used to go quite often there for family reasons. We didn't have electricity. The accessibility was very difficult through road. The train service was scanty, and there was only just a weekly market. But when we see today, accessibility has improved of the roads through highways. The train corridors have come up. There is electricity, power is there, as a result of which we have better water supply. We have better hygienic sanitation facilities. Markets have come up. It is no more a weekly market. And the price or the value of that land in that particular village has gone up, as it also has connected on one part Dhanbad, which is the coal mine area, and the other part Kodarma, which is the mica mine area. All are industrial areas. So if that land value increases, and if anyone has a land, let us take a Gram Panchayat or similar authority, they can use, and that I will explain later, the incremental value of that land for raising funds. I will explain that later, and making further investment in the region. For a private sector who has that land can also raise funds, and we'll explain that later. Monetization is one area which we'll come to, and also use that as a source of fund for his business and industry. Primarily, the value capture finance or VCF is referred to as a public financial tool. Public financing tool in the sense, as I mentioned, and in the welcome address also, Arya has very well indicated that this is used for infrastructure development, primarily by the municipal corporations, by the local authorities, because it is they who generally initiate, sponsor, or lead the infrastructure development that enhances the value of the land in the area where such development takes place, and uses that enhanced value of the land to acquire further financial resources, which we will see later how, and use for further development and infrastructure facility building. And that is why it is generally and primarily referred to as a public financing tool. A question which can come at this point of the presentation is, how come then this becomes a management accounting issue or subject. Yes, it is very much a management accounting issue or subject, because today it is not just private sector financing, it is also public sector financing which has a management requirement, a management accounting dimension. And therefore, you have to see how that dimension aspect can be addressed. I remember that once upon a time when I was working in a manufacturing company, my managing director called me and said that we need funds. I said, yes, we need funds. And he said that you are a chartered accountant, and I think it is your duty, your responsibility to find how we can get the funds. So, as a finance man, it is important whether it is in a public body or in a private body to know and to ascertain the sources of fund and to raise the funds for the institutions or the entities' requirement. And that is where this becomes a link between the management accounting financing, is despite the fact that this is primarily a public financing. So in some, VCF is in value of land. So that is the in sum, in brief, in nutshell, what the value capture finance or VCF means. I will just pause here, not for anything else, but just to know whether I've been able to communicate this concept so far. In case you have any doubts, you can just raise the issue later, but I hope I've been able to communicate what this concept is. Let us now look into this diagram. Yes, if you have anything, I move on. Let us move into this. Now, at the center of this inner circle is land. And I have mentioned that what is the item whose value we are going to capture or we intend to capture is land. So at the inner circle is land. The initiative taken through economic development, and when we mean economic development, it means, say, transit-oriented corridor, that is the road corridors which you have. The e-expressways that we are having today, say from Delhi to Moradabad and other places. The railway, you see, when the transport, which is not only the passenger, also for the freight, like we have the railway integrated freight corridor. The airports, the aviation, like the one which is proposed near Noida to come up, despite one having here in Delhi, in addition to, I would not say despite, in addition to. So the transportation development, not only it is an accessibility, a physical accessibility, it actually makes an economic connectivity. The economic connectivity in between the producer and the purchaser. It creates a connectivity. Then the telecom, that also creates a connectivity. That telecom, the internet, it creates the connectivity. Water and sanitation is important for livelihood, because you need, without this you cannot just survive. Health facilities, from primary health care to hospital, specialty hospitals, educational facilities. So all these creates an economic development through various infrastructure creations, and that enhances, I repeat, enhances the value of land. And that is why you will find with this economic development there is a value creation. And here again I would like to make one digression. If we look into from the Sustainable Development Goals of the United Nations, which says that by 2030 we should reduce of our poverty level, and it should be an inclusive growth. There is one very important term, LED, that is local economic development. And world across, the focus is being given on local economic development, which in the process enhances the value of the land where, or in and around where this economic development takes place. You can very well, corroborate that, support that contention, because what was Gurgaon, as I mentioned to you, 40 years back, and what is today in terms of development and consequent value of the land is well known to all of us. Once that value is created, you have to realize that value. It should not remain unrealized. And that you realize how? That increment in the land value you realize, because then only you will get funds in your hand. And for that there are different tools which we call LBF or the LBFT, land-based fiscal tools, which is actually helps you to capture the value. And once you get that, you again put in that money and you start the investment process. So this becomes a cycle, and this is a virtuous cycle in the sense that you use what you create to enhance the value for further enhancement of the value, and therefore it is a virtuous cycle. Now we are coming to that what are the various means or the various tools available for capturing the enhanced value of the land. In the first 2-3 slides, we will just see what are the tools, and in the subsequent slides, we will see that a little more detail about the tools and in which parts of the country are these being used. The first tool, and which is a very common tool for most of the local authorities, local bodies, is the land value tax, LVT, the land value tax, which is a tax is imposed, is calculated based on the value of the property. So it is based on the value of the property. It may be a slab rate, that if you have this value, and this will be the tax amount. The value of the property has gone up from earlier, therefore for the local authorities the tax rate has gone up. This can very well happen in many of the peri-urban areas, many of that what we call places which we can say rural, but has become an extended urban area. There it can work. Of course, in cities we generally have, based on various other unit measurement routes, but this still is working in many of the places and is one of the tool for capturing that value by the municipalities or the gram panchayats or the local authorities, by whatever name you call. That is the property value. On that you put a rate. As the amount of the value of the property increases, goes up, your tax collection goes up and you get extra money. Of course, the underlying assumption is that the collection mechanism has to be efficient. That is a separate issue and is not within the scope of our discussion. So this is one simple and easiest mean to get more money, which you can use both for your operational costs as well as to earmark some of it for your capital outlay. Second is a development charge, or sometimes called as impact fee, which is imposed by the local government, that is the municipal body or the development authorities, to pay for a portion of the cost of the new projects or the proposed development projects that are coming up. Now, how does it work? We will see that later. It is actually a one-time charge. Unlike the LVT, the land value tax, which is charged recurringly, that is annually, on the property, this development charge or impact fee is a one-time charge. That a particular area which is defined or designated, where you are having various types of developments all to come up, you can, where you are having public investment to be made, you can have the private sector or your existing landowners to develop some other facilities. I will give an example, but to get the permission for that, a development charge or an impact fee is levied with reference to the potential market value of that property. Meaning that if, say, let us take the case of a new region, a new place, where, the municipal bodies have taken to, what is it called, fill up the marshlands, okay? Like one which was done in Bandra Kulra region by MMRDA, Mumbai Metropolitan Regional Development Authority. They developed, they have cleared, they have filled up the marshland, and to reduce the pressure, the congestion on the commercial complexes, the commercial areas of South Bombay, to reduce the traffic congestion in that area. And this was developed, this was done, and then they invited the private parties that, okay, you can have your buildings, commercial complexes, markets, etc. But for that, you have to follow the town planning, the master planning requirements of the authority, and in addition to whatever you pay as your charges for the planning, approval, etc., there will be an impact fee or a development charge as a percentage of the potential market value of that property in future, and that will be collected one time. And it is more, like you are realizing a portion of your cost through these development charges. Like, I will give you a simple example to understand this concept of development charge, that many a times we have seen that you have a land, you build up a house, you take a loan from the bank, and one condition is that the ground floor or a part of the area of the house that you will build up will be given out to bank at a concessional rate of interest, a rate of rent. And so it is, you get the bank's fund, you build up the house, and then you let it out to the bank at a concessional rate. So the thing is that the bank also benefits and you also benefit. Your cost is obtained through the bank fund, through the land, and the bank benefits through a concessional rent agreement as well as a charge. So something like that, which is this impact fee. I'll come back to this again if I have confused you on this issue. Other one is the betterment levy. This is also a one-time and upfront charge on the land value, as when you go for development of or creation of any building, any asset, any type of structure on the land. Now, what is the difference? Let us go back between impact fee and the betterment levy. In the impact fee, you have just leveled the land. I've said that in case of Bandrakulla, the marshlands were filled up, the marshlands were leveled, and then the MMRDA invited the private sector that you develop your commercial complexes, you develop your structures, your buildings, etc. But for that, in addition to whatever other present existing charges for fees for getting the permission, you have to give a development charge one time, and that is how they recovered the cost, or they added for the actually not recovered the cost, they actually realized that to build up further infrastructure. In case of betterment levy, the development is done, meaning the road is laid out, the sewer pipeline is laid out, everything is done. Now you are allowing the private party or whoever that you construct your structures, and for that a betterment levy. For example, if we go, I will give you an example later in this course of the presentation, that in the outer ring road of Hyderabad, when it was built up, there was a betterment levy charge for those who were constructing their houses or their structures or their commercial places in and around that particular region, and a betterment charge, the advantage of development made by public infrastructure investments, that is by the town development authorities and the city development authorities and municipal corporations, and therefore for that you have to contribute because you are getting that advantage in addition to whatever is the other fees that you pay for your application. Now this is, you recover, you have invested, you recover. But in case of the impact fees, you are laying down the infrastructure development, your construction, at the same time you are also inviting and providing the private parties to come in and develop their things as per your plan, for which you are charging an impact fee, which is actually like not that whatever you have invested you are recovering, but that is going as a source for your investment prior to making the investment. Like many a times you may see, as finance people, we recommend that when you are constructing some commercial complexes and or even residential complexes, you take some advances interest-free advances, or you link it with your construction, the payments, what happens in the process is that these funds which you get from the buyers, they actually go as contribution to your investment. You actually use that for making the investment, and when ultimately at the end of the whole construction, your part getting over, you hand over the possession. That is the time when you really make the whole handsome profit. In between you may have some profit, but very marginal or low. It's mainly going towards the contribution towards your investment. But in case of betterment levy, it is not like that. You have invested, you are now recovering it through an upfront charge. So it could be a full recovery, it could be a part recovery, and that is the difference between development charges or impact fee and the betterment levy on the other side. The other tool through which the land value can be captured is transfer of development rights, that is the TDR. Now, what is this transfer of development rights? It's a very, very new concept, I would say. I would not say very new concept, but a very, I would say, innovative concept. Innovative means it is a process by which an additional built-up area is given to you in consideration of the area that you have surrendered, meaning there is no cash transaction. I have a property, I have a land, I have given it to a municipal corporation or a public body. Or the government. But I don't get surrender, I relinquish. Instead of giving me cash compensation, the government or the municipal authority gives me a right which I can transfer of building up an additional built-up area, either on this land, the part of the land in that same place that I'm still holding. I'm not giving the entire land, I'm giving a part of it, so part of it is with me, or in some other area where I have a property, I have a land, and an additional built-up area right is given to me. Additional built-up area right meaning that according to rules, I may not be allowed to build up, but yes, because of this surrender, that right is given to me. This basically works quite well, where your expansion on the horizontal level is difficult because of the, I would say, the shape of the land, the configuration of the land, the scarcity of the land. Like say, if you take Mumbai, horizontal it is difficult, whereas and it goes generally vertically up, whereas in Delhi you will find horizontally it is better. Okay, so where such things, this TDR is of relevance. And second one is that this is transferable right. It is a transferable right, which means I can sell this right. I may not myself use it. I can sell this right to somebody else who is willing to use this right for additional built-up area. In many cases, you may find that where you have some spaces to be given out, this is used for giving the developer the scope to have additional built-up area so that he or she can get compensated through the additional built-up area. But there is one caveat, and the caveat is that you have to, when you build up additional built-up areas, you have to follow the other safety norms and other infrastructure norms. It cannot be, just you build it up without taking care of the safety requirements, fire safety, etc. norms as per the town and country planning requirements. So that is a TDR, which is quite an innovative concept which is coming. And of course, it is still not, marketable or tradable in any commodity market or any such market. Okay, it is just you can sell. There is no organized market as such. The other is a premium is charged on additional floor space index or floor area ratio as a one-time charge when you are giving the permission for using additional FAR or FSI. This generally happens when you have the transit oriented corridor and you can allow some more population density, and there you can give this additional FAR floor area so that you have better FAR, better space, higher space, and you charge one time premium for that additional as when you are giving the permission. The last one I would say is the tax increment financing or TIF. Tax increment financing is a bit tricky, and bit tricky in the sense that there is incremental tax. There is increase in property tax, or there is a surcharge levied on property tax for certain properties which are within a certain defined or designated area, because it is that area which is defined or designated to be further developed, and as it develops, therefore the value of the property, the value of the land will enhance, and so those properties or those areas where there is private sector owners, for them there is a surcharge. It is also a type of impact fee, like in the sense it is a source of fund to build up or to lay out or to construct further developments. So I have identified a particular region, a particular location in a city where you will do some development, and when you use the development there, you create the development there, then those who reside, those who have properties there, their surcharge is made. Now, this thing is a bit tricky because it creates discrimination, and it can lead to some disputes. But you see, in the case of smart city, there is a concept of, one is called pan area development, that is across the city, which is to be made smart. And the second is an area-based development, which is a specific, a defined area within which the development will take place. And therefore, for that specific areas, you may have this TIF, which is the tax increment financing, for the properties which will benefit out of this development, while others in the pan city will not have that same advantage or benefit. You can use this tax increment financing. I was just remembering or recapitulating that when this smart city proposal for Udaipur, which is in Rajasthan and is a very hot tourist spot, the sources of funding was being considered for particular area-based development, particularly near the Udaipur Lake, where you have a huge that lake hotel, which is one of the premier hotels of the country. The development which takes place, why not have a tax increment financing? But there were a lot of discussions, and there were issues that this can raise the point of discrimination in taxation. And so we opted out and we put a sort of a tourist fee at that point of time. Of course, at that point of time, we didn't have this COVID-19 pandemic, and so the tourist issue was not a big major issue, and we had that, so shifted from the TIF to the tourist one. But this could be used, and in many countries this is being used. Having described and listed that what are the different tools by which the land value, increment land value could be captured, let us now go slightly in depth with each of these tools. First is the LVT, that is the land value tax. The land value tax, if you look at it from a theoretical perspective, it is a progressive tax. Progressive tax in the sense the heaviest burden is on the owners who have the valuable land. So where there has been maximum improvement, maximum development, there the land value will go up, and therefore the owners will have higher amount of tax. Just to give you an example, that if you see two places which are very much in the vicinity, very much close, but from the development perspective there may be a difference. In South Delhi, you just consider, say, Greater Kailash and you consider Govindpuri. They are very much in vicinity, but the development, there's a degree of difference. And so, though both areas have developed, but because there being degree of difference in the development, the tax in certain areas like Greater Kailash is much higher than that in Govindpuri. So it's a progressive tax, and it is widely used internationally in countries like Denmark, Australia, and New Zealand, because it captures the increment in the land value and therefore the property value on account of the development. It also discourages speculative investments because if you hold on to those investments for making more gains, you pay more taxes. And in a way, it reduces the inequalities. In India, this is levied in Tamil Nadu and Maharashtra in some places. I'm not talking of Mumbai and Chennai. I'm talking of in the state-wise, in certain places of Tamil Nadu, certain municipalities of regions of Tamil Nadu and Maharashtra, to capture the value increment. But please remember, not on the agricultural land. This is not levied on agricultural land. That is for variety of reasons. There being policy to encourage or to help the agriculturists. And there are variations in the rate structure. As I told you at the beginning when we started discussing these VCF tools, that there is a rate, slab rate generally, the variations in the rate structure, amongst the different states. Some stipulate this is the maximum and this is the minimum, and some say this is the percentage, whereas others don't indicate any limit. So it is still a bit of a gray area in certain states, but it is in vogue in some of the states. Impact fees, I explained to you, I repeat again, is a charge for the development projects, and I mention here, I want to underline here, it is not a cost recovery, it is to help to contribute to the construction of the improvement or the expansion which is being done. And this is linked with the potential market value, and therefore it is periodically revised because the market value may change. You say potential, so that means it is like a bull and bear in the stock market that you are looking for. You are in a scenario, so it is periodically revised. It was introduced in the United States of America in 1970, and it became very popular with their development in full force in the 80s. And it is still in India in a nascent stage, though it has been working in Andhra Pradesh, Gujarat, Maharashtra, Tamil Nadu, and Madhya Pradesh, which levies impact fee and collects it upfront while granting permission. That I told you with the example of Bandra Khulra, that once the land, you just cannot have the land like that for any development. You need to level it, you need to make it in a proper shape, and then only the development can take place. So when you partly do the development from the public sector and then you give a sum for the private sector, as per your plan, as per your master plan, urban plan, then you collect an upfront fee for the development from the private sector parties, and that is called a development charge or impact fee. It is like getting an interest-free security or an advance while you are making an agreement for selling an apartment to a buyer. The other is, betterment levy, which captures, already you have incurred the cost and you are recovering it. Since 1921, it was working in Colombia, which is in Latin America. The United Kingdom imposed this betterment levy equal to 40% of the land value gain, not land value gain, please mark that. And in the United States of America, this is also imposed to get it, recover the cost. Cities like Bengaluru Municipal Corporation, that is Brihat Bengaluru Nagar Nigam, Hyderabad, Greater Hyderabad Municipal Corporation, Mumbai, and certain other cities, they also follow this charging of the betterment levy. When after the entire area is developed by the public sector and then somebody wants to get permission for the plan, permission approval for their own structure, a betterment levy has to be placed. You will find this, for example, there was at one point of time when new airports were coming up, there was a passenger fee which went for the servicing not only of the operating costs but also recovering some of the capital costs that was invested or used for building up the upcoming airports. Then, as I said, you have the transferable development rights, that is the TDR, which is used for trading the development rights. I think we have discussed that. We have had a long discussion on that. So, and as I mentioned that this is a very innovative concept where you don't have the cash compensation to be paid, and most of these public bodies like the municipal corporations and the city development authorities, they are very much cash starved, and therefore for them this becomes a good option, a better option, without having to pay out cash to give this right, and whereby the owner gets a scope and opportunity to build up extra area to even sell that right and get the money, and therefore it is a good one. It was first introduced in the New York City, then Maharashtra, Karnataka and Gujarat. They have enabling laws for using these TDRs for developing open spaces, promoting affordable housing. You see, affordable housing is a big venture today in our country. So, where you are giving up something, you can use that for additional built-up area for the affordable housing. I know of a case being done in Bhubaneswar in case of affordable housing. And this could be used also, where the heritage or the cultural resources are being preserved. So you take that up and give them that additional right to build up area, for additional built up area, and they can go and do it in some other places. Premium on additional, this is justified, resulting in higher carrying capacity of the neighborhood. And I mentioned that where these transit-oriented development policies, they often permit denser population along the denser development along the augmented transport corridors, because the capacity is much large, and therefore additional FAR is allowed. This is being used in Brazil and France, and is quite widely used in Maharashtra, Karnataka, Gujarat and Tamil Nadu. Then we come to this other one, which is the, I'll just go back to this, it is TIF, which is the incremental finance, tax incremental finance. And this is generally very limited. It is mainly project-based intervention and levied annually for a fixed period of time. It is not that once such charge is levied and it continues, permanently or perennially. No, it is annually levied for a fixed period. That means it is revised, and the term is also fixed, and it is project specific, that where you have a specific project to develop some area, you do it, otherwise you don't touch it. It is working nationwide in the United States, but again project based. In India, Hyderabad has used TIF for funding development in 800 peripheral neighborhoods. As I said, it's a very project based. It's 800 peripheral neighborhoods in which they use this when they were planning and developing that neighborhood. So it is a bit complicated and dicey, and therefore its use is also quite restricted. Now, having discussed that, the point is, how do you select that what means of value capture tool will you use and how we will use? Because we know what is the item which is having enhanced value. We know why it is having enhanced value. We know that we have to capture that enhanced value. And we also know the tools to capture the enhanced value. But how do we implement or operate or work it out? First, as in all cases as finance men, we need to know the capital generation required? What is the fund required? So you will get from your projects DPR, you will get from your cost estimate. Second, that if we use the land as a source of fund, if that is the identified asset, that this is the development and therefore this, what is the potential of that development? You may not have that potential everywhere. It depends on number of factors, because there are lands which can be, instead of you capturing the value, to put it in a lighter vein, please pardon me saying so, the ocean captures the land, that is, or the sea captures the land. I have seen, in Bangladesh, when a multi-purpose bridge is to be constructed across the river Padma, and which will enhance the neighborhood land value. The river meanders, it changes its course so often that the potential of the entire neighborhood as enhancing the value of their land did not really work out, because for that there's a lot of meandering and what we call as, how to arrest that meandering, we had to work it out, and so therefore the potential was not that much. So one has to be very careful that is it that every land will have that potential? So we have to identify that land, that asset particularly. Second, that what is the complexity of the development? Complexity, there could be number of complexity in the development. If it is near a heritage site, if it is in a particular zone which is restricted for certain uses. So these complexities you have to keep in mind, because those will have a bearing and influence on the land value that you expect to increase. And then comes the bidder preference, that is, who would be the right people to do. There could be a lot of people who can come in, but the selection of the bid, which we generally do in any of our projects, and the competitive forces at that point of transaction. That is, you see, competitive forces would be that if I enhance, if I do the development here, how will it match with the development elsewhere? Or with this, what else can we have to do? You will find that there are many areas. Today, I sometimes get confused that, IT being one of the major, I would say, not emerging, it has already emerged, growing potential business. Every region you will have asking for IT, but what is that is required, which are the competitive force which will really attract that investment in IT. So those competitive forces have to be kept in mind and have to be addressed. Like in case of IT, if you develop a particular area, you need also, as I said, in case of habitat, it is not just brick and mortar houses, but water, sanitation, education, health facilities, road, markets, etc. Similarly, you need educational institutions which from where you can get the crops for employment in IT, because it is the human resource which is of most important. And in IT also you require a lot of, this recreation and other facilities. So that space is required. So the competitive force is important, and the time frame, that what would be the time. And that is where you need to build up in a way that will help you to assess the requirement, the specific land, dealing with it in a project style, project mode, understanding the complexity, the competitive forces, the bidder preference, and how to, rationalize the time frame. Rationalize the time frame is that do we make it a very long, then people will wait, other places, other states can have the development done and attract, better land value. So how to do, and there is a term which is coined by someone called HINT, HINT, and it means higher impact near term, so that you put the project in such a way that it has a phase-wise development, but in the first phase, which may not be a very long-term phase, you have that impact where people see the development, the land value goes up, people come in, and then in your next phases, the attraction, the pull factor is much better. So that is how the usability of the tools for VCF can be done. Now, this is I just wanted to give that in case of a transport corridor or a multimodal interchange facility, where you have the trail, you have the road, you may also have the river transport. One good example is near the Cochin International Airport, where you have the Perrier River, you have the rail, and you have the air, and you have the road. And close by is the Cochin city as well as the spice capital there, and have substantial positive impact on the adjacent land values as the airport came up and this multimodal thing came up, and is a financing and could be used as a financing mechanism. This I just wanted to give you as an illustration. So you have specified tax levied on properties. You can have incremental tax, which is another financing strategy, capture a proportion of the growth in property tax. And some cities like Seattle in the United States use the tax levied on properties, incremental taxes, which is again project basis. Impact fees in Hong Kong they use for the rail transit system. So that is where we complete our part on how the VCF could be used for the public bodies in raising the funds. Now let us come. Can we extend this concept to the corporate sector, which includes both the public and the private corporate sector, companies? Sorry. I'll just... Now, we have seen that land is required for setting up business operations. We have also seen that land is recorded at historical prices. As well as we know that the market value of land could be substantially higher as the years pass and as the development takes place. Now the point here is, which is a repetition of what I mentioned earlier, that with development, if you recall the graph that I showed, with development it goes up, the land value goes up exponentially. Without development, it goes up because the demand grows with increase in population, increase in their usage factor, but the supply of land being definite. So with this land value increasing, how it can be monetized, which again is another way to call VCF, value capture finance, and raise funds. And that being your own land, you can reduce your debts by paying it out substantially, or not going for debt, or making your organization a debt-free organization, which many companies today try to achieve. Especially in today's uncertain economic environment induced by the COVID-19 pandemic, using real estate as a source of liquidity is an for the corporate. That is, the land and the building that you have could be used as a source of liquidity. Okay? Now the point is, you will say, how can you use the land? I'm not saying that you can use the entire land. What you can use is that part of the land or that part of the building which is unused or underused. Today, I will pose a question, or rather I would say make a submission for your thoughts, that when we talk of work from home, and when prior to the pandemic, it was not always work from home, maybe for some organizations, but it was physical presence in the office. Don't you think that if the work from home becomes the new normal, then the space that you would have otherwise required prior to the pandemic, that space would reduce? And if you own that, then that could be well utilized, because if you follow the work from home culture or the norm under the new normal situation. Second, are you using the land and the space in optimum way? I will not mention the name of a company, but I have seen a huge land with a huge structure, with a spacious room for senior officials and the managing director, which was not that much necessary, except if you want to show extravagance, and that space could have been better utilized for earning the funds or the revenue. So the potential sources for existing land-based revenue through infrastructure development on commercial basis, renovation of own buildings which are underused or unused, could be utilized. You see, in a different way. It could be an auditorium, community hall, plaza, etc. Like today, when you go to these metro railway stations, you see on the top floor there are offices, there are other commercial purpose for which it is used. Take a very simple example. The places which is the intermediary storage space for all the waste, this garbage, you will find outside walls are all painted and are given for advertisement, and there is a revenue. So what I'm trying to say is, we can see whether the real estate which we have all is required or is being utilized or not. The second one is that if you have two spaces, one say in Connaught Place, I'm just giving by way of example of Delhi, and another maybe a slightly in a different place, can you not use some as back office or something in that place, and or the head office also to that place, and change it, this Connaught Place, for other purposes where you can earn some money? At one point of time, let me tell you, I've seen in Kolkata, the hub of the business was what we called Dalhousie Square. Now it has changed to BBD Bagh. Today, many of the offices have moved from Dalhousie Square to Salt Lake or to other areas which are, you can say, away from the main city center. But those buildings, those land areas are used otherwise and funds are being generated. So that is a thought which we could consider, and especially if you want to revive the sick companies, the ailing companies which have huge lands, old companies, and are not being properly used or utilized. What are the steps for this monetization? That is, converting the land into a monetary value, that is into fact. First, identify which are the holdings, which are underused, which could be otherwise used. Second, check the title of ownership, because that is a very, very important thing. Many a times, we are not very clear on the title of the ownership. Many a times we find there is legal issue on that. Make an assessment that for what use, a proper, suitable use, this place could be made for. Could it be made for commercial offices? Could it be made for restaurants? Could it be made for some other purpose? What is it? Then you get the DPR and the approval of the competent authority, because there is a change of use or you want to make it different. And then you invite bids or you select, through the bidding process, the people who will invest and who will develop as per your plans, as per the approved plan, and they will invest and they will give you that money which you will have for investing in your business. So that is the process, almost similar. If you go back to this slide of using the tools, VCF tools properly, and you come here, you will find that this land monetization has a similarity in the steps to be followed. I would like to mention one thing here. A real estate company, mostly known as JLL, the Jones Lang LaSalle, in a recent research study that they have made, they came out that the Indian companies, across various sectors, it is not only in a particular sector, that it is only in the power sector or it is only in the manufacturing sector, or not like that. Across the sectors, the Indian companies, they can retire long-term debt, repay to the tune of $341 billion by monetizing their respective real estate assets. This is not what I am saying. This is not what is my finding. This is the research study that has been carried out, and the finding is of that study of a leading real estate company, Jones Lang LaSalle. You will find many companies having prime properties in prime locations, which many a times are not appropriately or suitably used, and therefore they could be very well identified, very well listed, very well checked about ownership and other legal things, and appropriately developed and given to the operators or developers for proper use and realization of their value. Having said that, there are challenges. And obviously, in life, it is not petals of rose. We must remember, even rose has thorns. So there are challenges. And the challenges are, number one, that the ownership title has to be looked into, because most of the problem lies in the ownership title. Is it a freehold? Is it a leasehold? Is it a land which has been given or received under any state industrial policy, and therefore there is a caveat on the selling or disposing or otherwise using of the land? All this needs to be looked into. Second, making a proper assessment of the valuation. There are a lot of, valuation is a subject which I would like to mention, is like, the relationship between the bull and the bear. You tell me, same company, same share, same time. One says the value will go up, the other says the value will come down. That is the bull and bear. How? It is the perception, it is how you look at it, on its usage, on its futurity. So valuation has to be done properly. Documentation is important so that everything is clear, title and other things. Taxation issues is not, of course, a part of our today's discussion, but is a point which needs to be taken into account. And because of all this, the deals generally take a longer time to close. So therefore, these are the challenges which we need to keep in mind, and also understand that it is not in walking on a rose petal or the bed of roses. We must also remember that rose also has thorns. So what is the way forward? Do we end with challenges? No. Where there are challenges, we must also find what is the way forward. First, the mindset of the corporates who feel that owning the real estate is of utmost importance needs that the real estate, be it land or the building or the structure, is owned to be used. And if it is not properly, appropriately, optimally used, then that money which is locked there is not properly giving you the return that you should have. So, if required, if it is possible, you unlock that money, which is monetization. Second, asset monetization generates, that is, asset in this case is the real estate, land, properties, new sources of revenue by unlocking the economic value of poorly used assets. It is the mindset which we need to change. It is not that, my balance sheet will not show this land, this property. And therefore, especially in this current pandemic-induced business environment, monetization of land can help the corporate sector to reduce the debt substantially or to raise funds for new investment. In other words, value capture finance emerged as a tool, as a means for raising funds by the public sector, namely the municipal corporations and the city development authorities and the like, for infrastructure development as the value of the land enhances. And taking cue from that, the corporate sector can also consider, may not be in the same way, but in a different way, in a way which suits the corporate sector, to capture the enhanced land value. Okay. So with that, I think we are coming to the end. I will thank all of you for your kind attention and thank Gurgaon chapter for giving me this opportunity to be with you, to present whatever I could, and the committee of the Institute of Chartered Accountants of India of Management Accounting. With these words, thank you and over to you. Any question, anything, you please let me know and we can discuss.
Thank you so very much, Amitabh for your deliberation. You have explained an innovative topic of value capture finance in the bestest possible manner, given the time constraint. I know with the experience you have in your kitty, you can go on, and there are a lot of topics associated to this topic, which will be taking up in next seminar. Now I think we must jump to query session and take up some of the queries of the members. The basic query which I have been getting from different members is, what is the role of a CA in value capture finance? How a CA can play a role in this new concept and make it as an opportunity?
You mean that what is the role of the CAs in this? Am I correct?
Yes, sir. Yes.
I couldn't get. What is the role of CA in this value capture finance? Is that
Right.
Okay? You see, it is a very, very important role for chartered accountants. The point is, if you go through the process, be it for the public bodies or say a smart city company, or be it for the corporate sector, the process is important because we have to assess and identify that how much, whether this land has that potential to be otherwise used, what could be its potential value, may not be exact value, which you will come to later on, and how it could be disposed or used for further, raising of the funds, the stream of income or as a one-time stream. The reason is a point which I would like to mention with your kind permission, that usually it is thought that finance is a standalone profession. Finance, particularly CA, they are not a standalone. They have to be, and the non-CAs also have to understand it is a partnership. When a DPR is done, a DPR has a technical part, has a commercial part, has a financial part. We as finance person is not only concerned with the financial part, we are also concerned with the commercial part, because we can question that whether it is commercially feasible, marketable or not, bankable or not. Technical, we may not be that much proficient, but still. So therefore, the finance of the CAs have an important role to advise the public sector, the public bodies, particularly smart cities. We have over 120, I think, smart cities, and all of them, most of them are going for VCF, and many of them are not aware as to how that could be done. Because of paucity of time, I could not show. There are cases of cities like Faridabad, like Chandigarh, where, sector-wise it is prepared how and where from you can get the value from the land development. So that role is there as an advisor. And from in-house as a company, if you are working, of course, you have to find out that how you could use, particularly in the post-pandemic induced situation where I mentioned, where work from home becomes a new normal and you have the space almost unused. Many of the offices I've seen in Gurgaon also looking a vacant look because people are working from home. So as an advisor, there is an important role for the chartered accountants, and there are opportunities. There are, at least in the public sector, people are looking for such advice from CAs, practicing CAs in particular.
Very well said, sir. I think this needs another session from you, the opportunities for CA in this virtual capital finance.
Yes, another session.
I have another question.
Yes, please. What is
Can we
that?
take one more question, sir?
Yes, please.
Okay. Someone has asked, does the TDR entitle the owner to develop another property or the same property?
Does the just come
TDR,
back once again?
Transfer.
Transfer?
TDR, Transfer
Right.
of development rights.
Right.
Entitle the
So,
owner to
what
develop
is,
another property?
No, the TDR is that you have a right to have additional built-up area, and that right specifies that what is the area that you have as a entitlement to build up, which could be in your same property, part of which you have surrendered, or it could be in some other location. And that right you can sell. You can sell that right, and the value of that right generally in the Western countries is given by the authority who gives this TDR. Otherwise, it is the market value. You can just sell it off at whatever value you get it. Obviously, it has to be higher than the base value which you have got from the authorities. So it can be sold off, but we don't have yet a concrete developed market for this TDR for transactions as yet, so far as India is concerned. But I hope it will come up over a period of time, and there again, the CAs will be required to do the transaction, the structuring the transaction.
Very well said, sir. With this, I think we are done with the queries, and you have explained everything so very beautifully. There are no other queries from the members. And on the behalf of the Gurugram branch of NIRC of ICI, I would like to extend a really hearty vote of thanks to our eminent speaker, Amitabh Basuji, who has spared his valuable time from his tight schedule to deliver on the innovative topic of value capture finance. I would also like to thank Committee on Management Accounting for arranging this virtual CPE meet on such an interesting topic and inviting such an experienced personality, Mr. Basuji, to this meet. With these words, I would like to end up today's meet, which has been a very lucid, informative and practical lecture. All our compliments to you, sir, and thank you so very much again. And at last, if you would like to summarize a topic, we have 2-3 minutes with us. Over to you, sir.
First of all, thank you very much, Ritesh ji, for all your kind words and the attention that I got from all of you in this deliberation. My humble submission would be that this is a topic, a subject which has a number of dimensions, and one very clear dimension which came out in the queries that was raised that what is the role of the CA, number one. Because you see, as CA, we should know that when we are dealing with a new subject or an emerging subject, what is our role in that? Second is that how the gray areas like TDR could be improved upon, and it is this profession which can contribute also quite significantly. Having said that, my humble submission is that this, if time permits, sometimes in future, you can consider a better bigger session, or I mean bigger session in the sense I'm saying that another session where we can take up specific case A, the role of chartered accountants for VCF. That is a totally, quite a wide subject, because your question of valuation comes in, your question of project feasibility comes in, your question of transaction structuring comes in. The second is that where there are gray areas, even from the Gurugram chapter, there could be suggestions which could be collated maybe by the institute or by some authorities and placed to the government for future improvements. These are good contributions to by the profession, to the profession as well as to the society. That is what I would say to sum up my, today's presentation, covering the queries that has very rightly come up. So over to you, sir.
Thank you so very much again, sir. I would like to thank all the participants, members for this virtual CPE meet. We would like to meet again on the topic. As you said, this is a vast topic. We'll be covering each and every aspect, and we would like to hear it from you again, sir. Thank you so very much, sir.
Thank you. Thank you. And just one last word. When you come to this question of CA, you see there is another issue which is very much linked with this value capture finance, and where there is a big scope. In India, we do not have as yet, except by the CAG, who carries out the proprietary audit and the other audit. The CS can carry out value for money audit. Whether it is a public sector, public bodies, or a private value for money audit, which could be a new type of practice for the chartered accountants. And that is a must. I know for certain, I can tell you, in UK, there is this value for money audit for the public sector, that is the municipalities, and it is compulsory, mandatory. So that could be another thing which we can consider, linking this VCF. And we can discuss that at a later session. Okay.
Rightly, sir. Now I think with the time constraint, we need to say goodbye, and it was a very insightful session. Once again, sir, compliments from me and my whole team, and congratulations to Committee on Management Accounting for holding such an insightful session. Thank you so very much, sir. Once again, would like to hear it from you again in near future.
Thank you very much. Thank you, and God bless all of you. Thank you. Thank you.
Okay.
So with your